Good morning, good afternoon, everyone. This is Rob Barnett, and I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in energy markets. Quickly on the call today, we've got Patricio Alvarez joining from his new location in Madrid, so make sure to say hello to him if you ever pass through. From his normal perch in Dubai, we've got Salih Yilmaz, and swinging over to London, we've got Will Hares. So truly global team, folks distributed all over the world. And if you're watching this in a replay, make sure to like and subscribe. We want to make sure that as many people get some of the great insights that we often discuss here on the call. So just a quick check-in. Relatively green screen when I look at the commodity energy landscape today. Oil looks like it's around $83 a barrel when you're looking at Brent. Uh, European gas just shy of 30 euros a megawatt hour. So let's do a quick commodity check-in as we normally do. Sally, we'll come to you first. What's your read on the oil market at the moment? And I would note you have a note out just a couple days ago on kind of OPEC's role in where we are at the price.
Sure, thanks, Rob. So oil was actually down earlier this morning when I checked, and I think the main overhang on prices has been Fed comments on how they're watching inflation very closely, and they don't seem to be in a rush to cut rates, and this has obviously been a big driver of oil prices and a huge overhang on oil prices. But I think it's turned green this afternoon, afternoon in Dubai, mainly because of the news that we got on Saudi Arabia increasing its official selling prices to Asia for next month. This is clearly seen as a bullish signal. This is generally an indicator of where Saudi Aramco and Saudi Arabia sees demand from its customers for the next month. So that's obviously positive. But other than that, it's generally the same drivers that we've been talking about on here that we continue to watch. Geopolitical risk remains high given the war in the Middle East, but we haven't really seen any disruption to oil flows, and that's why impact of that elevated geopolitical risk on prices has been quite limited. As you mentioned, we did have the announcement by OPEC Plus of the extension of their voluntary output cuts into the second quarter. This wasn't really a surprise. I think this was very much baked into the market expectations, but it shows that the group still has unity within itself. They continue to be very much focused on supporting prices versus market share. They're not really giving any indication that they're going to shift their focus from prices to market share. Also, dollar. I think dollar is down also today. That might be one of the reasons generally for commodities to be higher on the day, and also the wider sentiment in the markets. When I look at the wider equity markets, it all seems quite green. So a few drivers that usually tend to move oil prices that we watch very closely. It is more positive than negative for today, and I think that's why we are seeing green on our screens.
Okay, Will, let's swing over to you. What do you make of oil in the mid 80s, and give us a sense of how that's feeding into the energy major earnings profile? Are things looking pretty bright for the oil patch here at the moment? How's it translating into earnings?
Yeah, so the only thing I would add to Sally's comments is that seeing some encouraging economic data coming through, strong jobs out of the US. The UK just put out the autumn budget, spring budget, excuse me, sorry, and included in that was a stronger than expected outlook from the Office of Budget and Responsibility for hitting roughly 2% inflation by the end of the year, which is much, much better than we had late last year. So the outlook is improving. The U.S. still looks strong. The likelihood of the U.S. achieving a soft landing is looking higher and higher. And so, given this, I think it's contributing to some of that oil tailwind we see on the demand side, and particularly when you frame it against the new OPEC cuts that have just been extended by 3 months, and we think could even be extended further through the second half of the year. And of course, yeah, with oil at 83, 84, mid 80s, pretty strong pricing backdrop for the energy majors, and we saw that in 4Q results that's just concluded for their earnings season, with performance across the board stable to higher, but pretty encouraging though, and we think this momentum is likely to extend in the early parts of this year. This is of course led by their upstream units. We're probably going to see the strongest liquids price capture that we've seen in 5 quarters in 1Q. This will help offset some of the gas weakness we started to see through the end of last quarter, which has pushed into 1Q as well. And of course, refining sort of remains a bit of a weak spot here, and a drag on overall performance. But upstream strength has been incredibly strong across the board, and of course for the larger European majors with significant trading desks, we've also seen the trading X factor be a material contributor to earnings, particularly for Shell in the last quarter. So overall, the backdrop is very supportive, and we estimate that distribution programs for the European group are going to be broadly flat from last year, maybe down just marginally by 5% or so. But I think that really shows that the management teams are still very committed to extending their very large buyback programs, and for those that haven't recovered their dividends to pre-pandemic levels, we think there's going to be continued growth through this year as the Europeans continue to try and close that valuation gap, that sort of 5 to 6 multiple valuation gap on forward price earnings with their American counterparts.
Salih, just real quickly from you, I think you've got Saudi Aramco earnings coming up this weekend. Is it a similar expectation from your perspective on where they're going to be? And just give us a sense, where are they at on the valuation metric and the sort of gap that Will described? Where's Saudi Aramco on that front?
Sure. So Saudi Aramco is expected to release its 4Q results next Sunday. So they're really waiting until the almost very last minute to report their 4Q results. It is, I mean, very similar to other oil majors, the European oil majors, in terms of, upstream pretty strong. I mean, of course, Aramco is in a special position because pricing is pretty favorable, but because of the OPEC plus cuts, their output is actually quite limited at the quota level. So, I mean, for a company that has oil production capacity at more than 11 million barrels per day, they've been producing at just below 9 million barrels per day. So that's obviously a limiting factor. But otherwise, upstream is been pretty strong. Refining margins have been down from a very strong 2022, of course. But then, I mean, now that they have 70% stake in SABIC petrochemicals, market is very important for them, and there's been a lot of pressure on that space. So there will be relatively limited contribution from SABIC as well. But I think one big question mark, and perhaps question by analysts on the earnings call, will be around their announcement in late January on halting their plans to increase their maximum oil production capacity from about 12 million barrels per day to 13 million barrels per day. I mean, what we expect around this is that I think they will start to lower their capital spending guidance, because this was a project that was expected to take between 20 to 25 billion dollars in total. So halting that means I think we'll get lower spending guidance, which will give them a lot more room for dividends. We don't know if that means they increase their base dividend or they just leave. They already have a performance-based dividend mechanism in place. So the higher the free cash flow after spending, the more dividends they will be paying anyway. So this will be a discussion point, I think. So that will be interesting to see. And in terms of valuation, they do demand a valuation at the moment that's much higher than European oil majors, and even higher than the US majors, to be honest. And I mean, obviously they are in a very special spots, if you will, in terms of, I mean, this is a company that's responsible for the totality of Saudi Arabia's oil production. They have always had very strong government backing. They enjoy very favorable geology in Saudi Arabia, very strong, very low lifting costs, very strong profit margins. So, and of course, there's limited foreign ownership and limited liquidity, if you will. I mean, it's only less than 5% that's free floating. That could be one of the drivers as well. But when you look at the charts, it is Aramco at the top, and then US majors like Exxon, Chevron, and then there's a not noticeable gap between these players and the European oil majors.
Okay, very interesting. Patricio, let's bring you into the conversation. What do you make of the idea Will was talking about related to gas weakness? What's your latest read on where Europe's at from a pricing perspective? And give us your read across into power, gas, utility earnings from the full year results that are kind of winding down here at the moment.
Sure thing. So, in terms of European gas prices at the moment, it seems like they've started to recover, albeit not so much or limited. There's a limited recovery. We're hovering around 26 euros per megawatt hour when we were hitting almost 22 or 21 last week. And that should not be mistaken as a change in the fundamental outlook for gas prices, I think. And that's because the winter season has, for trading, is basically over. European gas storages are at an all-time record for this time of the year. They've never been this high since records started. So that means that traders are already thinking about next winter, and that possibly explains this little uptick to 27 euros per megawatt hour, which is not far from the long-term average for gas prices. So there's still, I'd say, some support. We're finding some support. Perhaps prices are not going to go lower. They're going to stay somewhere between 20 to 25, which is within what consensus expectations are. That's roughly 60% below what the average price was last year, and that connects with what Will was pointing out. All those optimization gains in trading are normalizing. We've seen sort of the same trend within power and gas utilities, which share that part of the business with some of the majors. All that commodity trading units are seeing normalizing earnings. We've also seen a decline in thermal spreads, so meaning coal-fired power, gas-fired power margins have collapsed. So that means that all the unhedged power has all those margins have been coming down, and that has been trickling down into profit warnings for 2024 and 2025 for all the independent power producers. So you're talking about your RWEs, you're talking about Acciona. You're talking about EDP, EDPR. Everyone is being hit by this faster than expected decline in power prices, and I think it also adds to sort of the pressure on the case for renewables, at least in the near term. It seems like development costs are not coming down as fast as power prices, and hence the appetite for off-takers to take long-term contracts has also diminished. So renewables are in a tough spot, but I think Looking forward, there's also been some positive developments on the policy front. So namely, we saw the award for Ørsted last week. They finally got the award for Sunrise, which was not within the secured backlog for the company. So it's actually an incremental sort of a capacity upside for them. It was also awarded at $150 per megawatt hour, which is significant, and it is also above most LCOE's estimates, but by the main consulting firms. So there's a positive, some glimmer of hope, I'd say, for offshore wind in the long run, and that also ties in nicely with the announcement today with the budget, with the UK budget, where they announced the biggest the biggest support for the biggest amount of money for subsidies, for CFDs, for contracts for difference for offshore wind. So that gives us some hope that this upcoming auction in 2024 will be much more competitive than last year, when we didn't see any offshore capacity being awarded here.
Yeah, very interesting. In addition to your react on Ørsted, I would just highlight we also had one out on Vestas. Vestas is the turbine supplier for Empire Wind, a project of Equinor, which also got approved at that $150 per megawatt hour mark. For folks who don't think about power prices, LCOEs, these kinds of things, you could do an onshore wind project for much closer to, say, $50 a megawatt hour, solars in range of $50 a megawatt hour, gas in range of $50 a megawatt hour. So the government in New York has basically decided to pay a premium to help develop the offshore wind industry. So it's going to be very interesting to see whether they can deliver these projects profitably at that much higher LCOE and hopefully bring costs down through time, because I don't know if there'll be an appetite to do a whole lot of offshore wind at that price point. So let's see how that develops. Will, I want to swing back over to you and get a sense on two things. One, I'm curious if you have any particular reaction on the offshore project development for Empire Wind as it pertains to Equinor. And two, I'm going to switch focus a little bit and talk about not offshore wind, but offshore oil and gas development, because I know you cover a number of the offshore energy service companies that have been doing quite well as of late. So tell us about both Equinor and kind of where the offshore oil and gas business is at, in your opinion.
Thanks, Rob. Yeah, so I'd say that the Empire Wind project is sort of represents kind of the lone wolf among the global integrated energy space, because it looks like it's moving ahead, and of course there's been a lot of impairments taken, particularly in the U.S. from some of the other projects that BP and Equinor's peers have been developing. But overall, offshore wind is these companies are treading very carefully within this space at the moment. Not just in offshore wind, but in renewables more broadly. I think it's very clear now within some of the strategic updates that we've seen through last year from the European majors that there's a tapping of the brakes as far as the energy transition paces are concerned, and I think that is largely driven by building concern over the returns risk, execution risk, profitability risk of these projects, particularly when you stack them up against their bread and butter oil and gas cash engines, in which they are approving projects at a 20 or 25% IRR versus it's a 4 to 6% on an unlevered basis for these renewables projects. So there's concern and caution about what this would mean for the returns profile for these projects, and so there is they're proceeding very carefully, or I should say more carefully than they were, a handful of years ago. And I think this goes up with some forecasts for peak oil demand, global peak oil demand extending a bit further than a lot of analysts had previously thought. More resilient oil demand, and we are seeing that also reflected in the capital spending allocation for the European majors as well. We're seeing an uptick in near to midterm oil and gas investment. And for those with U.S. shale, a quick payback period and fast production response from U.S. shale plays can be is one of the focus areas, but also some longer term offshore major projects as well. So this isn't to say that these companies' net zero plans are at risk. I think just the trajectory of declines when you look at the net portfolio emissions intensity of these companies is getting pushed out, and then it will subsequently become a lot steeper, from 2035 to 2040 onwards.
Thanks, Will. I'm just going to weigh in quickly as well. There was a comment in the chat about the impact that these contracts could have on rates, and I would point out that that $150 per megawatt hour is a pretty big number. Just to give you a sense, New York, the average retail rate is about 18 cents a kilowatt hour, so $180 a megawatt hour. So technically, the offshore wind is coming in below the average rate. But the way you got to think about the rates is that they're not just the electrons, it's also the transmission, the distribution, all kinds of other stuff. So generally, you think about the generation component as being about half the rate, and the transmission, distribution, other stuff's about half. So these are most likely inflationary type projects, and especially relative to other types of things you can be putting on the grid. A couple more numbers just to give you some context. Average price in California, which is also doing a lot of renewables, 22 cents a kilowatt hour, so $220 a megawatt hour. Big numbers. They're paying a lot for their power out in California. National average retail price here in the U.S. is about 12 cents a kilowatt hour, so $120 a megawatt hour. So anyway, if you're thinking about all these numbers, you don't think about prices in the power system, feel free to reach out. We can show you kind of where some of those numbers are at, and show you where the cost estimates are for adding new renewables to the grid. Patricio, I just want to come back to you. You just heard a pretty interesting take from Will on kind of energy transition spending. It sounds like your sense is that there's some renewed focus on that, but some disappointment perhaps in at least European customers, where they're seeing prices in the wholesale market come down, but renewable prices aren't coming down as quickly. So do you think that this is going to be a kind of headwind on the build out of renewables in Europe over, say, the next 12, 24 months?
So yeah, I would say the short answer is yes. So your average retail contract spans about a year or almost 2 years in the best of cases. So most utilities have 30 to 40% exposure on their revenue base to supply contracts, and those will roll over the next 12 to 24 months. And just so we get a sense, 2023 average realized power prices were around 100 euros per megawatt hour. Right now, futures are at around 60 euros per megawatt hour. So price realizations are set to come down significantly over the next 12 to 24 months. And obviously, those utilities that don't have access to the long-term PPAs, the power power purchase agreements in the long term, or CFDs, those are the companies that will suffer the most. So again, you're talking about mostly the conventional generators, the companies that don't have a big share of wind and solar, which tend to be long-term contracted, and it's mostly the utilities that are supply biased. So you're talking about your Centricas, you're talking about Enel, Endesa, and other companies with an integrated mix, meaning that they also have transmission assets. So like your Iberdrolas, they will have they'll have more tools to weather this lump in power prices. Although we do note that we expect power prices to recover or at least stabilize over the long run, just because there's obviously the policy support, so on the regulated front, but you also see that carbon allowances are just too cheap at the moment. They've fallen by more than 50% over the past 6 months or so, and well, the policy mandates that carbon prices should rise over time to reduce emissions. So I think the outlook in the near term looks challenging, but over the long run, electrification and power demand should recover, and hence power prices should stabilize. Perhaps we won't see the records of 2022, but yeah, the utilities made money before the energy crisis, and over the long run, there should be a recovery.
It's fascinating to watch the European carbon market, and I love this notion that emissions keep coming down faster than policymakers anticipated at some point in the past. So they kind of try to tighten the cap to keep the pressure on prices. Let's see how that goes. Will, I want to come back to you for a comment before we have to conclude. One of the things you did is you closed a focus idea here at the beginning of the month. For anyone who doesn't know, focus ideas are our highest conviction, typically an out of consensus type call. So tell us about your latest one that you closed, and yeah, I'm very curious to hear your concluding thoughts on that one.
Yeah, so we just closed a couple of days ago our focus idea on an Italian offshore energy service company called Saipem. Our view, which we put out at nearly a year and a half ago, was that the company would significantly outperform last year on both top line and EBITDA margin basis, and the company did reporting their 4Q results, which which blew estimates out of the water, and I think this fits quite well with my overall view for the offshore energy services space this year, because Saipem is recovering very strongly, and this is particularly good because they had struggled massively in late 2021, in which they had several negative commercial settlements, material ones. They had booked a lot of unprofitable contracts for offshore wind installation, and this culminated in a large and painful backlog review of about €1 billion. This was followed up subsequently with a management change out and full strategic review. So I think this is really a massive signal for a ongoing recovery, not just for Saipem, but for the broader energy services space, where which has struggled significantly and has had a very hard time in the last several years. Low margins, massively curtailed investment from their upstream operating clients, and significant backlog pressure as well. And all of these have already turned around, and we think this momentum will build in 2024. We're seeing a much tighter offshore installation market building through this year and next. The renewables units, which have been built out in these companies, are really starting to contribute, both on top line and on margin, and the bidding pipelines are deep, and also with significant pricing power that these companies have not seen in years and years. So we see really solid top line growth this year, solid margin growth, and we're just amid a wave of order intake for these companies as I mentioned before that oil and gas investment from some of the large players in the upstream space are starting to tick up a little bit, and they've waited a long time. These companies like Subsea 7, Saipem, Technip FMC, and they are really starting to reap the rewards of a finally a much more supportive macro backdrop for this subsector.
Fascinating. One more piece of research in sort of take a couple minutes of time here to go over that I'd like to hit today is Salih. You also here have put out your latest update on your oil fair value model, which is a collaboration that BI has done with Bloomberg's data science team. You've got a Python-based tool that you've created, and very cool stuff. Tell us about your note and tell people how they can access this model if they want to run their own scenario.
Sure. So this is a multivariable regression model that we now have available for our clients. For anyone who is interested, I mean, this is part of the research note that we published, and through this note you can click through the image and access the model. If you cannot find it, please get in touch with me, and I'll send the note over to you. And this is basically, as you mentioned, the collaboration that we've done with our data science team, where we've gone through a lot of potential variables that we thought would be important and would be driving oil prices, and some were as important as we thought it would be, and some weren't. So we've filtered through, and we've ended up with things like inflation expectations, refining margins, inventories, and a couple more drivers. And we've only had it for a few months. I mean, it's had a pretty decent track record so far. Currently, in our latest version, we see fair value at around $85 a barrel. I mean, the oil price has been just slightly below that number. But I think the point here is that it is now a tool that's available to everyone. We obviously have our own assumptions. We have the current market values, but what this tool allows is for everyone to put in their own assumptions for all these variables and see where the fair value goes. And yeah, I mean, it is. This was published last week. It's under my bio. That's one way to find it. But as I said, if you're interested, you can just directly get in touch with me, and I'll send the model over to you. Thank you.
Yeah, thanks. For anyone who's listening live, we'll send a follow-up email here in a few minutes with the link to Salih's note so you can find it. So I think that'll be a good place for us to stop for today. I would note that both Salih and Will have a marketing trip coming up very soon in Singapore and I believe Sydney. So if you happen to be in Singapore or Sydney, reach out to us. I know they've got some events planned. We'll make sure you can get looped into what they've got going on in the region. And yeah, we want to make sure we're not just faces on a screen, someone that you can see in person. So we'd be delighted to help make sure you can join that. I would also flag that here in the US, we've got a big event coming up in about a month's time in Kansas City. That I'll be speaking at. Some of our other colleagues from the agriculture side will also be joining. So it's a bit of an energy ag mix. If you're interested in that, also happy to get you the details. So look forward to being in touch, and I hope you have a great rest of your week. Thank you for your time, everyone.